Welcome to Season 1 of Margin Talks by Finaloop. Don't forget to subscribe to the show's newsletter for lots of free exclusive, expert-led content in the links below.
So welcome everyone to Season 1 of Margin Talks by Finaloop. I've got a great friend, ecom entrepreneur, and my tennis sparring partner, Ben Cogan here. Ben, welcome.
Thanks for having me. Appreciate it. And thanks for not beating me at tennis too much.
I think we're tied so far on games. So we're gonna dive straight in and then backfill with background. So we're gonna try to start spicy. Ben, you and I both own seven-figure e-commerce brands. Seven-figure e-commerce businesses, assets or liabilities?
Oh, good question. All right. I think I'll try to. I think the sort of non-cynical answer is they're assets, and I think that's generally true. So the way I think about it is, look, legally, if you're a corporation, you only have you don't have liabilities. The company goes out of business, or you don't have personal liability usually. And so if the business is profiting, you get the profits from that. So in that sense, it's an asset. But I think there's a couple of senses in which you're right that e-commerce businesses can definitely be liabilities. So one sense is, and I've seen this, I'm sure you have too, where founders will take out debt for the brands and they'll be personally liable for the debt. In that case, obviously an e-commerce business can be a liability because you have debt on the business that you're personally liable for. Second, I think I've seen a lot of founders, again, you have as well. I've seen a lot of founders who have personally put in a lot of equity capital into the business for the sake of inventory growth. And then maybe they won't recoup their investments. And so in that sense, the business can be a liability if you put in a lot of money up front and you don't recoup your investment. And then third, in a sort of more subtle way, I think a business can be a liability insofar as the profits you make from it, if it's a smaller seven-figure business, if the profits you make from it are not particularly high, there's an opportunity cost, right, to running that type of business. And so a business like that can be a liability if you otherwise could have made a lot more doing something else at a conventional job. All that being said, I think most people who run their businesses do make money from them. And so I consider them generally to be assets.
No, I think totally fair. And I ask my question obviously in jest, but at the same time, I think you and I have both been very passionate about building some awareness around the subject matter. Nearly 15 years each, or at least easily over 10. And at least I thought of even seven-figure e-commerce businesses as being worth a couple of terms of revenue multiple. That's amazing. However, but I think it's almost certainly not true today and likely hasn't been for the last 3 years. And so therefore, if the value of that business is most likely a multiple of EBITDA, which would be a fraction of a multiple of revenue, then everything else that you said absolutely comes into play, i.e. the liabilities on the balance sheet, the opportunity cost. And I think that's the purpose of the question. And that's something that I actually don't know if the median brand owner has fully appreciated. Maybe it has, but I still think that a lot of brand owners still think about their businesses on a revenue multiple as a starting point.
Yeah, I think that's right. Look, for a long time, businesses were trading at revenue multiples. I think in other parts of the market outside of e-commerce, a lot of businesses still do trade on revenue multiples. So it makes sense that, maybe they can get a revenue multiple, but it's very unlikely these days, unless they're growing incredibly quickly and usually profitably.
So you've got Jacob and Fan here to walk us through some of the more technical elements of the things that Ben was talking about. Ben and I were obviously somewhat in jest talking about whether seven-figure businesses are assets or liabilities, but to actually fully flesh out what are assets and liabilities and a bit more about what is the balance sheet, we've got Jacob here from Finaloop. Jacob, walk us through what is a balance sheet and why is it important?
So the balance sheet, after discussing the P&L, as we said, may be the most important, but balance sheet is also a really important financial statement, giving us really good visibility into where the company is. So the balance sheet gives you like a snapshot view of what the company has and what it owes at a specific point of time. Just like the P&L, it could be annual, it could be quarterly, it could be monthly. If you're using software like Finaloop, it could even be daily. And it tells you what your assets, meaning what you have, what your liabilities, what you owe as a company, and your equity, which is your assets less your liability in any given period. Now, it's really important to actually gauge the financial health of a company, because you can have two P&Ls that look more or less the same from two different companies. But if you really want to dig down into their financial health, you need to understand their balance sheets. Meaning one company could be totally over leveraged and based on a lot of debt, and their working capital ratio is no good. And the other one, totally bootstrapped, no debt or very little debt, and is a much healthier company. But you're not going to necessarily see that from the P&L, but you will see that from the balance sheet. So it's really important to look at both of these statements together, right? So that's just kind of a general comment. Diving into the actual balance sheet, the balance sheet is divided, like we said, into assets, liabilities, and then equity. So the assets are divided into current assets and non-current assets. Current are generally assets that are more liquid or that I tend to consume in the upcoming year, such as cash or cash equivalents in my bank accounts, etc. My inventory, which I intend to sell in the upcoming year, obviously. My account receivables, meaning money that is owed to me from, let's say, wholesale, prepaid expenses, etc. So all of those will be included in my current assets. And then my long-term assets would generally be, let's say, capital expenses like investing in a warehouse or those sorts of investments, which would have a lifetime of more than 1 year. And after that, I have my net, my total amount of assets. And on my liability side, I have a similar division of short-term and long-term liabilities. My short-term meaning money that I owe in the short term, like credit cards, like various account payables, which is money that I owe to third parties. It could be payroll liability, which I owe to my employees. It could be other third parties that I owe money to, like vendors. I could have deferred revenues or other accruals, which is money that I received but didn't actually provide the goods or services for yet. Like if I have a sale and I get prepaid for, and I didn't actually provide those goods. And it could be short-term debt, which is due in the upcoming year. And my long-term liabilities, which is just below that, would generally include long-term debt, which is due in over a year from now. And now the basic accounting formula, without getting into details, is if I take my assets and I subtract my liabilities, I'm left with my equity, which is what I actually have in the company, my owner's equity. So we're not going to really dive too much into equity. Maybe we'll do that at a different point. And equity looks different depending on how you're incorporated and what your structure is. But that's more or less what it means, meaning how much money you put into the company as an owner. And we also have our retained earnings flowing from the P&L, like what I made this year and in previous years, that will flow into my equity section of my balance sheet below. So that's more or less a bird's eye view or a view from above of what the balance sheet looks like.
To then zoom out a little bit on background, Ben, you've always someone that I've looked up to, partly because you're 6'7", partly because you've been a trailblazer in e-commerce for the last decade. I'd love to get a minute on who is Ben, what is the company Agora that you started and with today, and then please brag as much as possible.
I guess my background in e-commerce has been a bit over 10 years now. I started in management consulting and worked for a couple of legacy brands that were fending off D2C and e-commerce upstarts, which I always thought was interesting. So saw it from that side, actually, a little bit. And then I worked at Harry's, the men's shaving company, from 2014 to 2016, right when Harry's was sort of getting off the ground, when it was initially considering going to wholesale. Business was, I think, revenue-wise, about 2% of what it is now. So it was really cool to see that business from near its starting point. In 2016, I co-founded a company called Hubble Contacts, which is a direct-to-consumer contact lens and now glasses company, which got to be a pretty big business. 9 figures. We raised a lot of money to get there. So of course, easier to do it that way than to bootstrap up. But that business was really exciting. We grew really quickly. I think we were similar to a lot of the mid 2010s businesses, different categories that, spend a lot of money on marketing, grew really quickly. Hubble did eventually get to profitability, which I'm proud of, but a lot of the other brands around our time did not. 3 years ago, I started Agora, as you mentioned, which is a direct-to-consumer aggregator. So we saw, even in the mid-2010s, all these brands growing as quickly as possible, burning a lot, but a lot of them weren't really cash flow positive. We thought the exciting part of the market was the bootstrapped, profitable part. We wanted to become more involved with that. We saw what was happening on the Amazon side of the world. And so we started a similar type of business on the e-commerce D2C side of the world. And we've been doing that for the last 3 years.
Amazing. One of my least favorite parts of e-commerce or consumer brands in general is how much competition has proliferated. For each brand that we own, there are 100 competitors. For each brand that we see, there are 100 competitors. Shopify has been proud of, and I give them a lot of credit for making it easier than ever to start an e-commerce business, but that only helps invite more competition. Is it good to have no barriers to entry to e-commerce, or does this end up being a net negative? And a follow-up question to that is, do you think the aggregate Shopify ecosystem is profitable or unprofitable?
Yeah, I've written about some of these things online, and I know we've talked about them a lot as well. I take a more optimistic view on this than you might think. I think in aggregate, Shopify brands are profitable. And I do think in general, it's good for consumers that there are so many competitive brands and various spaces and various niches. I also think it's generally good for entrepreneurs to have lower barriers to entry at the beginning. Once you're trying to enter a market, it's much easier to get in. If it's low cost, you have Shopify, you have Klaviyo, you have other tools that you can just launch a brand easily with. Later, of course, as you said, when you want to sort of lift up the gate or the drawbridge behind you, and you can, the thing that made it easy for you to enter a market is what makes it easy for everybody else to enter the market, which is what drives down prices and lowers margin and increases competition. To the question about aggregate profitability, I really draw a distinction, and I've spent a lot of time looking at e-commerce P&Ls. I'm sure you have. I know you have as well. I draw a distinction here between sort of actual profits and the Econ 101 concept of excess profits. So excess profits, when you study economics, are profits that you make beyond what you'd expect given the returns on capital invested in the business. I think e-commerce, the vast majority of e-commerce businesses have no excess profits, meaning a business owner might run a business. Let's say it's $5 million Shopify business, to use your example. Maybe you'll make $100,000 or $200,000 a year in actual cash flow as an e-commerce founder or owner in that type of business. Maybe your accrual-based profit is higher, but you constantly have to be reinvesting and additional inventory for your brand in stock-based compensation. The actual cash flow to you might be $100,000 to $200,000, and that is profit to you, but it's not excess profits. If you run a really high margin SaaS business that's doing $5 million in revenue, you can make $1 million or $2 million a year, and that is pretty high relative to the revenue. I think that's really rare in e-commerce. It happened for a couple of years during COVID. I think it happened at the beginning of the Facebook boom in ad prices. I think it can happen for a year or two, but if the barriers to entry in an industry like this one are low, competitors flood in and reduce the profits that you can make as an owner of a business down to the opportunity cost of running the business versus another job you might otherwise take.
Are you saying the market now is at the point of maturity that it's fully efficient?
No, of course not. I mean, this isn't like selling corn, econ one, literally perfect competition. You can make excess profits, I think, in some cases, and there are brands out there that do. I just think it's really hard. And if you do, it's sort of like the Alice in Wonderland, like Red Queen. You constantly need to be a step ahead of every competitor, launching new products, launching into new types of marketing channels in order to, I think, maintain really high levels of profitability. Does that reflect the mature market? Yeah, maybe. I think it's different than, Google doesn't launch new products for a year. They're still going to have ridiculously high profit margins and cash flow. So it's different than that type of business.
So you have Jacob and Fan here again, and I really wanted to bring Jacob in here because Ben talks about a very astute point. You know that Ben's been operating for a dozen plus years because he tells us about the importance of actual cash flow net of capital needs and ongoing working capital. And specifically that just because you have a profitable P&L, it doesn't mean that there's additional cash in your cash flow statement. So, Jacob, help educate us, the audience, on the importance of the cash flow statement and maybe some of the differences between a cash flow statement and an income statement.
Yeah, so the cash flow statement is the third, I'd say, of the really important financial statements, being the P&L, balance sheet, and the cash flow statement. Like we said before, the P&L, which should generally be based on accrual accounting, does not actually show me how much cash is flowing in and out of my company and won't really give me such great visibility into how the cash is flowing. So that's what we need a cash flow statement for, which is a statement that could be annual, quarterly, monthly. If you use Finaloop's kind of software, it could even be daily. And it shows you how much cash is actually flowing in and out of the company, regardless of how it's registered from an accounting perspective. So I can have either an indirect statement or a direct cash flow statement. Indirect reconciling between my bottom line and my P&L, which is like the net profit or loss, and the changes in cash on my balance sheet. And it'll just have the differences, meaning why the cash flowed like this, but it wasn't registered for accrual reasons in my P&L on the other hand. Or it can have more of a direct cash flow statement that will kind of throw all cash movements into this cash flow statement. Either way, the various categories are going to be separated usually in the standard cash flow statement into three. And I have my operating activities, which is my working capital, my day-to-day cash flowing in and out, like buying inventory, making sales, paying employees, paying third parties, etc. All of my really day-to-day working capital kind of activity. And then next, I'm going to have my investment activity, which is more kind of long-term investment. Let's say buying a warehouse, for example, or making other kind of investments of that sort. And then the third kind of activity would be financing activity, which would be, let's say, taking out a loan, which is providing me financing and cash flow coming in, or paying back a loan, cash flow going out. Interest expenses sometimes will be included depending on your methodology, either here or in operating activities. And after summarizing these three amounts of activity, what's coming out of my operational activity, my investment activity, and my financing activity, I mean, you get to a final cash flow in and out in a given period, and that should fully reconcile with the movement in my cash and my balance sheet. So that's kind of just a general picture as to how cash flow statements work.
Excellent. Now back to the episode.
Over the last dozen years, you would have touched every corner of e-commerce, seen every function, probably operated in every function. What is your favorite part about e-commerce, and what's your least favorite part?
Yeah, so to go back to what you said, one of the things I really like about e-commerce is it is one of the most accessible forms of entrepreneurship. You know, I'm not particularly technical. I know how to code kind of in SQL, but I'm not a programmer by any means. So we'll see after AI if that becomes commoditized a bit. But I think one of the cool things about e-commerce is it's a form of entrepreneurship that basically anyone can do. And that's something I really like about it. And it's what sort of I wanted to be an entrepreneur. It's what drew me to e-commerce as a field. I also really think the community is amazing. Met a lot of really smart, great people. Everyone almost to a person is really generous and willing to give them their time and to people who are not their direct competitors, and sometimes even to their direct competitors. So I think the community here has been great. One of the things I like about it is unlike other types of entrepreneurship, you can work from anywhere. You sell nationally, sometimes internationally, so you can work in different parts of the country if you want to move around, or different parts of the world. And you can work with different people from around the world. You're in Australia now. I'm in the US. That's one of the really cool things about e-commerce. And one of the other smaller things is, compared to a lot of friends who work in various esoteric fields, like it's pretty easy to explain what you do. When you talk to somebody at a cocktail party, it's like, I sell contact lenses, or, I sell golf clubs, and that's pretty cool, both because it's easy to explain and also it's tangible that you're selling something that you can touch and that's real to consumers.
And the other side, things that you don't like about e-commerce?
It's the flip side of what we were talking about before. The fact that it's super accessible to you and you can work from anywhere means that it's super accessible to everybody, and anyone in the entire world can compete with you. And you're even seeing that now with like Amazon brands, right? Most Amazon brands until a few years ago were generally American entrepreneurs. Now you see Chinese entrepreneurs who control production directly creating their own brands and launching on Amazon, and sometimes launching D2C companies. They have meaningful advantages versus effectively American distributors who just add margin, or they're adding value too, but they're not producing the product. And anyone who has basically an internet connection and a phone can launch a business, a dropshipping business to start. Generally, if they have some capital, they can buy a little inventory and get the ball rolling and launch a business. So that makes it really, really hard. Now, I know we keep coming back to this topic, but I do think it's really important. And then something else, e-commerce, you're just getting constant data and pings. I get emails when we're launching for various businesses. You could do customer service like at all hours of the day. You get email tickets all the time. You can update your ads or adjust your targeting like from a minute to minute basis. You're just constantly getting information and data that makes it difficult to turn off sometimes.
Yeah. No, that makes sense.
I don't know if you feel the same way.
Yes. No, absolutely. I find it. I chuckled to myself when you said the. One of the advantages of e-commerce is that you can work anywhere, and that I think that every time we've met up to being at a different WeWork office in New York, so you've explored the full surface of WeWork offices in Manhattan to experiment with your remoteness. You've bought a number of e-commerce businesses. What are some learnings around kind of opportunity selection and even around diligence?
Learned a lot here. I think I've learned a lot of humility, for one. It's almost impossible, I found, to predict in advance what type of business is going to succeed, and things that have succeeded or not have succeeded have done so for reasons that I've been unable to predict, and the team has been unable to predict in advance. I think that's just the nature of business, probably, not just buying businesses, but expect the unexpected, to say the least. Other things I've learned, which we knew, but I think have been reinforced. Founders want to found and entrepreneurs want to be entrepreneurs. And so if you buy a business and it has an existing management team, the existing founder, it's very likely that they're going to leave. And usually they're pretty upfront about that. And you're upfront about that with them, that that they're going to want to leave eventually. So you can incentivize them to stay for a while, but either they'll like officially leave or kind of check out and do something else, which I don't blame people for once they sell their business. So making sure that either they have a team below them that can replace them once that happens, or that you yourself as a buyer of business or your team can step in for the functions whatever the founder's doing, that is incredibly important. You should just expect that you're on the clock once the business is purchased. Other things we've learned, I'm sure you've heard of the Lindy effect, where things that have been around for a long time are likely to be around for a long time. I think that's just very true. And we've seen in our data, the businesses that had less operating history, had not been through several cycles, they hadn't been tested, they hadn't shown that they could consistently sell their products and fend off new competitors or had good enough brands to do that. And so businesses that have been around for a while, they generally trade at higher multiples for that reason, but it's very clear why. Businesses that have been around for 5+ years are much more likely to stay around than businesses that have been around for like 1 or 2 years. And then other things that I think we've learned as a buyer, if you're buying businesses in a ton of different categories, it's very difficult to understand each category as well as someone who's only working in that category. And so, either you could have a great GM in place who lives and breathes the business, but if you, as a manager running the business, or at least helping to manage the people who are running the business, there's a lot of value in businesses that have consistency from year to year. They don't have to constantly launch new styles, constantly launch new products. Maybe they have new products every once in a while, every couple of years, but some consistency from year to year gives you time to understand the business, figure out the sales cycle, figure out the customer. So when you do need to launch new products, you actually can understand how to do that rather than sort of being at the whim of having to constantly change out the business model of what you're selling every 6 months or something.
Yeah, no, that makes sense. Inventory-based business has been almost always need capital. How have you approached capital markets, equity, credit, as you've heard?
Yeah. Look, the capital markets in general, the last 3 years for e-commerce businesses have been really tough. Very few equity investors are investing in in D2C or in e-commerce anymore. I think the idea is you should be profitable from day one. And if you aren't, then there's something wrong and you shouldn't need additional capital. I think there's some exceptions to this. If you're growing really quickly and you need to buy inventory, but so many investors have been burned, both equity and debt, that I think it's been much more difficult to get capital the last 3 years than it was before. We have increasingly in the last few years moved to equity over debt. We did raise for Agora meaningful amounts of debt. We ended up paying off most of it a couple of years ago when interest rates rose. Cost of capital is higher on the equity side. You have to raise at a lower valuation, but you're giving up equity. It's lower risk than raising more debt and much higher rates. So that's generally the approach we've taken.
Yeah, it makes sense.
So you have Jacob and Fan here again, and Ben, who has raised equity financing over a number of companies as well as debt financing, says that in today's market, he'd take equity over debt. I'm sure Finaloop's seen many customers raise all types of different capital, but for the moment, talking about equity financing, what are some of the methods of equity capital that you've seen Finaloop customers take and might be available for our listeners?
So just first of all, as a general note, the market's not in a great place, right? Everyone knows we're not in the heyday of 21 and 22 anymore. In general, raising capital and debt, and specifically in the e-commerce world, it's been really difficult, and pushing companies to really try and become profitable, not just grow that top line and look at your gross sales and revenue and not try to build an actual model that works. That's just a general point. With that said, there definitely are, we've been seeing customers with all different kinds of either debt or equity being raised, or hybrid instruments like CLAs and safes. Just from a high level, obviously there are advantages and disadvantages to each. I'd say equity, full-blown equity, a lot of times would be a little more advanced companies. That's what we've been seeing, but not necessarily. Right? You have to really think it through if you want to be selling a portion of your company. There's all kinds of other considerations to take into account. Could be really expensive. Just the legal work, getting an SPA out there is more expensive than a CLA or safe generally. Anyway, it's just worth thinking through whether you really want to be having an equity agreement at this point and stage of your company's life. In certain events, if I like preferred shares that convert under certain conditions, I can also have a misalignment in the future between the founders and the investors. Founders can end up with literally nothing in certain cases. So anyways, it's worth really thinking through whether you want to go for equity or classic debt, which might have interest payments involved, and obviously not giving up part of your company, but you have a different amounts of risk. So it depends on where you stand. And the middle road would be having a convertible instrument like a CLA or like a safe, which are generally much cheaper from a legal perspective just to get those documents out. Safes are famous, they're created by Y Combinator. They're supposed to be simple agreements for equity, but at the end of the day, they're not so simple. And you can end up having an MFN clause, which really lose your pants in future rounds if there's a down round or whatever. But there are lots of advantages to safe, not just the costs of getting it out there and the fact that it's quicker, but also you don't necessarily need to really discuss the valuation. Not as much of a discussion as with equity, even though you do have a cap, and obviously there's discussions around discount rate and when the instrument converts. But just in general, like everything in life, there are advantages and disadvantages. Safes and CLAs are quicker, cheaper. They might have less involvement of the investor. Sometimes investor involvement is actually a good thing. They can be very helpful on your board, etc. So usually when it's more of an equity round, there might be more involvement, not necessarily. But that's just kind of a very high brief and overview of what we've been seeing and about advantages and disadvantages of different methods of raising equity or debt.
Excellent. Back to the episode.
Black Friday, Cyber Monday. It's coming up soon. Every year it feels like it's starting earlier and earlier. The end point, I guess, is Black Friday, Cyber Monday, all year round. How are Agora brands approaching Black Friday, Cyber Monday this year? Are you guys doing anything different?
Yeah, something that we did this year for several of our brands is we decided to have fewer sales. Some of the operators had sales like every month. You have a July 4th sale, or a Labor Day sale, or you have a Halloween sale, Arbor Day sale. Really anything you could have a sale every week if you wanted to. We decided to cut back in a lot of cases on that, which does probably hurt your ability to, of course, it hurts your ability to juice revenue at any particular time. But if you don't want to train the customers that you're going to have a sale all the time and you want to maintain your pricing power, I think that is important. The other benefit of that is when you do have a big sale, which we are likely to for many of our brands during Black Friday, it becomes much more important as a way to drive traffic. And, you can credibly say to your customers, like, this is the only sale or the second, like, one of 2 sales a year. So it remains to be seen, I think, this year, whether that strategy will work. I think it will, just because we haven't, for many of our brands, haven't had big sales all year, but that is one of the things we've tried this year.
Ben, as we head towards a wrap, a couple of fun closing questions. What's something that you tell your e-commerce operator self from 5 years ago?
So 5 years ago, 2019, right before COVID, I think we learned a lot about COVID. Look, COVID was really a demarcation point for the entire e-commerce industry. So if I could have told myself something, I think I would have told myself some of the things we did not know. Really, nobody knew about COVID before. So that it would happen, first of all, was really important. So bulk up inventory in advance. But I think a lot of people thought that COVID would be a permanently higher plateau of e-commerce penetration. I think it did change behavior a little bit, but that definitely was not the case. E-commerce, if you look at e-commerce trends, e-commerce as a percentage of overall commerce, it's pretty consistent to what it was from 2010 to 2019, or in the pre-COVID trend. It is actually reverting down, maybe a little bit higher than it would have otherwise been, but not much. I think a lot of people thought that there would be a sort of new normal, with COVID, with e-commerce penetration. So a lot of people really got over their skis. They overbought inventory. They expected demand to remain as high as it was during 2020 and early 2021, and that didn't happen. I would definitely want to know that in advance, of course. And then the other thing is, from 2013 to 2021, the focus on growth. I mean, this is not unique to me, but the focus on growth at all costs was definitely a function of the markets and zero interest rates, and was, and that approach to e-commerce has gone out of fashion entirely. One of the things that's great about focusing on profitability and cash flow is that cannot go out of fashion. Everyone always likes cash flow and profit, no matter what. And so if you build your business that way, when times are such that people are really focusing on growth, you can turn the growth lever on if you want. But when the markets are not focused on growth, or focused on growth and profitability like they are now, you can dial it back, get through to the other side, and show the markets what they want, which is profitability and cash flow right now. What would you say, I guess?
I don't think that's the way this is supposed to work, Ben.
The dialogue.
Yeah. Look, I think in addition to everything that you said, which I agree with, just being much more pragmatic. It's kind of where we open the conversation. For the majority of my e-commerce career, I just thought what I was working on was much more valuable. So to tell myself in 2019 or 2014 or 2010, it's, hey, kind of do this work with the understanding that this is what a potential exit could look like, and it's most likely going to be on an EBIT basis, and use that framing. Your workflow and is just dramatically different, right? You make very different decisions. And because we're all, even if as much as we love the work, everyone's still working towards some kind of enterprise value. And so that would be kind of my advice to myself 5 years ago.
I like that.
Ben, last question. For all of our listeners today, what is a product in the Agora portfolio that they should go and check out right now? What is what's your favorite product recommendation for your guests over these holidays? Sorry, for our listeners over these holidays.
Got it. For the holidays, one of the best products we have is from one of our brands called Kodiak Leather. We actually had some Agora branded, really nice outdoor. It's basically outdoor leather bags, and you can use them to travel, You can use them around the house. We actually had some Agora branded ones which we gave to the entire team a couple years ago, which I use personally all the time. So if I had to suggest anything in our portfolio, that would be that.
Amazing. Ben, I'm so grateful for your time. I'm sure our listeners will get a lot out of this conversation. So thank you so much.
Thank you for having me.
Thanks for listening to Margin Talks by Finaloop. Don't forget to like and subscribe on the channel you're listening to. If you have any questions or feedback, feel free to email me, fan@thehedgehogcompany.com. And if you'd like to see what Finaloop can do for your e-commerce business, please visit finaloop.com. We'll see you on the next one.